Hi everybody, today we have a conversation with Jason D'Agostino, who's one of the brokers at Preferred Shore, giving guidance and advice to our agents on both the residential and commercial side. And he also heads up the commercial division of our company, along with Taylor Yunis, who's an agent that recently relocated from the New York area to work with us here in our office in Sarasota. So Jason and Taylor are here to talk about the commercial market, some of the nuances that we've been seeing in commercial real estate, whether it be investment or sometimes owner-occupants, and just some general trends that we're going to keep an eye on as we progress throughout the rest of the year. So without further ado, I hope you enjoy this conversation with Jason D'Agostino and Taylor Yunis.
Welcome to the Preferred Shore podcast. Here's your host, Robert Milligan.
Jason, Taylor, welcome to the podcast, and for you, Taylor, welcome to the company.
Thank you so much. I'm thrilled to be here.
Great. Well, today I thought we'd talk a bit about commercial real estate and update our audience with some of the things that we're seeing, because of course, the market's just a bit wild and crazy to say the least. And before we do that, I thought maybe we could properly introduce you to our audience, Taylor, and maybe go into some of your background.
Excellent.
Yeah,
Sounds great.
Where are you from? I mean, start from the beginning here.
Yeah, absolutely. So I'm originally from upstate New York, the gateway to the Finger Lakes region. Elmira, New York is my hometown. And I was introduced to real estate at a young age because my father worked as a real estate attorney and a developer in a family-owned business where my grandfather and father developed shopping centers and residential projects both in Elmira and the entire southern tier region, as well as a vacation rental property on Keuka Lake in the Finger Lakes region. So I was very interested in visiting construction sites, and my dad always brought me along to his projects, and I felt maybe a little bit embarrassed as a kid to be dragged along, but today I'm really grateful that I was there because it sparked an interest for me. In college, I studied literature. I didn't, it was totally different from doing real estate, and people in my family said, don't pursue real estate because it's not essential to have an education in order to do it. Later in my career, telling that story, other people said it is not essential, but it doesn't hurt to have an education in real estate. So I graduated from the University of Rochester and moved to New York City, and I started working for a public relations company. Because I thought that would be a place to put writing skills to work. And I felt that it was not the right fit for me, and the income was not where I wanted it to be.
That's understandable.
I had investment banker friends who made a whole lot of money, and I thought there must be something in between.
Sure.
So I got my real estate license just 2 months before the financial collapse of 2008 in New York City. And at that point, the best. So starting out the first couple of months, I made $600 in real estate. And most real estate agents in New York start out by doing rentals because it's a way that you can make money in a short period of time and stabilize until you can start doing larger transactions. And people were moving around a lot during that time, the financial collapse. People were primarily downsizing, which was outside of the typical trend of the 3 reasons that people move, which is moving up, breaking up, and hooking up.
That's a cliche I haven't heard. That's a good one. We'll be sure to borrow that.
Do you think it's true?
That's true. I mean, there's a few things we could add, but yeah, for the most part, that encapsulates it.
Indeed. In that market, they were downsizing, and I learned very early on that I could either chase around customers, buyer customers, or I could chase properties and property owners. And someone very simply said that if I showed one customer 10 different properties, then that customer may not do a transaction with me. But if I showed one property to 10 different customers and it was priced correctly, that a transaction would probably happen. So after struggling a little bit, or getting my feet wet for a couple of months, I eventually got a job with a management company because that would allow me to have a property that I could show to people. and I was off to the races.
Awesome.
I started to be busy, and I was working for a relatively new management company, but it was quite large. But the one thing that was missing after a year of working with them was that I didn't have any experience in sales. Mm-hmm. So I had an opportunity to work for a management company that was a condo and co-op sponsor. And so I could rent out their rentals and I could sell their sales properties, and that's also the time that I was introduced to commercial real estate.
I see.
That owner had about 65 retail spaces throughout Manhattan. They did not have anybody in-house managing renewals and new leases. Mm-hmm. So that was my first introduction to commercial real estate in New York.
Interesting. Well, it sounds like an exciting opportunity, and of course, it's really glamorous being in the big city, and I think that I'm sure had to have been an incredible opportunity. So
it's a different world up there, that's for sure.
I'll be happy to show you how glamorous it is as I sweep up cockroaches before the customer arrives.
Yeah, well, you are part of a migratory pattern of New Yorkers headed to Florida. So maybe you could share how you arrived here in Sarasota.
Absolutely, yeah. I mean, I've been coming to Sarasota for my whole life as a snowbird, visiting family, which is one of the primary reasons I think that people are introduced to Sarasota, although that's changing today because it's a destination unto itself, whether you have family here or not. My uncle was living in Sarasota for over 40 years, so we would visit him. Mm-hmm. He had an investment seminar company and also got into real estate development. And a couple of years ago, I bought a condo here, thinking that it would be an investment and that I wouldn't make use of it until 30 years later, when I was looking to retire. But ultimately, coronavirus and the deterioration of quality of life issues in New York led me to say, why wait?
Yeah.
I've heard an expression from Eastern philosophies that people in the West are always getting ready to live. And so I thought, you know what, if that's my end goal, let's make it happen today.
I like that.
And with a diversity of experience and the desire to succeed and meeting some really stellar real estate professionals here, such as yourselves, I figured that it was a great time to do it.
Awesome. Well, I totally agree. And the two of you met, I believe your uncle is one of your customers from time to time,
That's
right,
right,
Jason?
That's right, yeah.
Yeah, that's awesome. Well, thanks for sharing that background. And of course, we're really excited to be working with you, Taylor. And one thing that's great about our company, your primary focus is commercial, but we do enable our agents to kind of do some residential things as well. So yeah, we're excited to work with you, buddy.
I'm thrilled to be here. And that was a huge reason that I felt comfortable joining the company, is that I didn't want a broker or team that I was involved with to tell me that I could only do certain types of transactions, or if I was doing commercial and I had a residential customer, that I should give it to a residential agent.
Right.
Having flexibility in a marketplace like this, where it's not quite as large as New York, but it has a huge volume. I think in one conversation when we were talking, people, once they arrive in Sarasota, they tend not to move out of the city, but they tend to move around the area pretty frequently.
That's right. Yeah, we have definitely noticed that, people from the barrier islands, they want to maybe take a break from the traffic or what have you, and they go out east for a while. Then they're tired of that and want to come back to the beaches.
Tired of the commute every day.
Exactly, yeah. So yeah, well, that's all fantastic. Really appreciate you sharing, and again, just so glad that you've found a good home with us here for your career.
Thank you so much. Me too.
Yeah. So Jason, we're wanting to kind of also talk a bit about what's just going on in the commercial market. And I know, Taylor, you've jumped right in. You've been active as well. So love to hear some of your observations, what's going on right now, because we've been on a roller coaster ride, to say the least, with all sorts of asset classes and all the different types of commercial real estate there are. Some have seemed to fare better in the current environment than others, but love to hear what you're seeing out there, Jason.
I would say down here, I think all of them fared pretty well with everything that happened. We definitely saw a large influx of cash to the state A lot of people seeking the tax-free benefits of living here, the sunshine, some of the politics as well. So we saw, just a lot of people selling their assets up north and moving them down here.
Yes.
So it's been a crazy year, and we've had a lot of investors that have, sold properties, done 1031 exchanges, and, it's just like the residential market around here right now. It's slamming. A lot of people, investors, business owners moving down here, retiring like Taylor, not retiring like Taylor, but moving down here, and maybe retiring, selling their business up north, and then moving down here for retirement, and then still kind of running a business on the side. But we've just seen a lot of that in Florida, and I think throughout the Southeast in general.
Yeah,
absolutely.
Well, everything has gotten kind of expensive lately, in U.S. dollars at least. We've had a conversation recently that U.S. dollars are not the only store of wealth. There's some interesting ways you can look at that, but in dollars at least, things have gotten kind of expensive lately. What kind of returns are you seeing out there for different classes of commercial real estate?
I think the returns definitely got squeezed. With the amount of people and the amount of competition that's out there. So, a property that would normally be a 7 or 8 cap might be a 6 cap now, just because there's so much competition and so much drive to these markets. Where in New York, an investor might say, oh, a 5% cap rate on this property, that's great. And then they come down here and they find something similar and comparable and say, oh, wow, this is a 6.5 cap rate. That's amazing. I'll pay this for it. Whereas someone like us who's used to this market might say, well, we don't know, that return doesn't seem right for that property. But a lot of people are coming down and just buying things up and parking their cash down here. We've even had some clients recently that are looking for zero cash flow deals. So they're looking to buy property that have no cash flow after debt. And, in 5-10 years, they'll pay off the loan and own it free and clear.
Wow. That's interesting.
Yeah.
So, do you think that the phantom depreciation on other taxable income is part of the motivating factor?
So.
Beside,
Yep.
That's interesting.
Get the depreciation, a little bit of the tax sheltering, and yeah.
Okay. Yeah, that's it. I've not personally run into a whole lot of that, but I'm not in your market as much as you are either, where that's pretty aggressive, 0% returns.
Well, comparing it to coming from New York, the regulatory and legal issues have caused additional risks for investors, particularly in multifamily, with an eviction moratorium and increasingly stringent rules that make it more difficult to evict a non-paying tenant.
Yes.
And so I see the cap rate going up as the risk of those, or perceived risk from those investors. Their expectation is that they want the cap rate to be above 10%. And the value is not increasing significantly during those regulatory issues increasing. So here, as the values increase, the cap rate is going down naturally. So these investors who are accepting little to no cash flow are betting that the value will continue to increase as more and more people come from the north to a place like Florida. And I think that those values may hold, unlike the bubbles that we've seen in the past that might have been caused by loose lending. Today, I think there's a real population surge that's supporting those values, and that should continue. And the other factor that we're seeing locally is not enough rental inventory.
Right.
Whereas before, several years ago, when home values were lower in this area, it was much easier for a retiree to afford to purchase a property. Today, if someone is coming from the north and they just want to try out Sarasota, they're probably going to try a rental for a couple of years to begin with. And there aren't enough high-quality rentals, particularly in rental communities, to support that migration. So renting single-family homes, though still an option, there are simply not enough of them.
Right. Yeah, and that concerns me. I mean, things don't have to end poorly necessarily, because I do agree there isn't the loose lending standards that there once was, but there can be equity bubbles too. Just because it's not rampant lending that's irresponsible, that doesn't mean that a bubble can't form. I'm not saying that there is one right now, and it doesn't seem like anything's on the immediate horizon that's to be of a serious concern. But it does, if you're looking forward a little bit, if I'm not mistaken, of course, the consumer price index is way up. Prices of everything is rising, not only housing and rents, but just all your day-to-day goods and commodities, services, everything has been going up. So if I'm not mistaken, I think in this area, the average housing expense for most tenants in the working class has been about 28-30% of their wage. Whereas now, if I'm not mistaken, I think it's near 50% of their wage. So, I'm a little concerned that perhaps as those factors kind of change, that people will have less income that's disposable, and so it's going to have an adverse effect on the basically just the overall economy. And so you'll see that earnings are down, revenues are down, and then it could trickle to everything. But I don't think we're on the immediate precipice of disaster there, but something to definitely keep an eye on.
Absolutely.
Yeah.
Absolutely.
Yeah, it's an interesting world right now with, very low interest rates and money flying around like crazy, all the pent-up demand after the pandemic. So it's certainly an interesting environment we're in.
Yeah.
Well, we've spoken to some developers who are looking to build more affordable housing, and our hope is that those projects move forward and that there is more affordable housing, so that the squeezing of the balloon is loosened to level out the prices, particularly with rentals, but also with home values in general. Because despite everything that Sarasota and the whole Tampa Bay area has going for it, it's not necessarily or historically a place that people move to for enormous wages.
Sure.
Or Wall Street South. We are seeing Tampa has recently been named the best city for small tech companies. Was it number 1 or number 4?
I can't remember off the top of my head.
Well, that's something for them to look up. We don't want to give them everything.
We can put it in the notes.
Yeah, here's the link. Yeah,
that's interesting. I know, definitely Austin, Texas has become a huge tech hotspot, and it is interesting to watch the migratory patterns of how businesses relocate as well. I'm curious. I know you're running with some customers to find space and things. Are you, Taylor, finding you can speak to this as well, that most of the people that are looking now, is it more for investment purposes, or is there some businesses that are trying to occupy the space, or what are you seeing out there, out of curiosity?
That's a good question. Well, getting back to having the flexibility to do commercial and residential, and touching on what you said about investors and individuals moving from the north to the south, is that we're getting calls from people who say, will you sell me a house and facilitate my 1031 exchange of my commercial property? So they're not just looking for additional investments in Florida, they're looking to virtually uproot their lives, dispose of all of their assets in the north, and take advantage of sunshine and favorable tax rates. So what we're seeing is a lot of people who are interested in shopping centers, retail. Some of them are looking for vacation rentals, which still seems to be a very solid and flexible investment, that if the property is not occupied, perhaps their family can come down from the north, or they can make use of that property in their off time. That's still a really strong business model. We are seeing some changes in restaurants. I mean, that's always been a really risky business, but we're seeing some restaurants sell and people looking to open new restaurants. I would say the trend we're seeing is from the independent owner to a better funded and perhaps multi-unit ownership. We're seeing a little bit of that. Not that we want.
Kind of unfortunate, to be honest, but
I agree.
Yeah, but that's kind of the way things go when things are a little riskier,
Indeed,
Absolutely.
indeed. And then we're also seeing some perhaps previously overlooked assets that might have been in developing areas, pre-pandemic and during the pandemic, some investors might have passed up on them because they needed too many improvements, or because during coronavirus people thought retail is dying, offices are dying, nobody wants these assets.
Right.
And just a little bit of recovery, and people are understanding that we always need a barber, we always need a check cashing store, and investors are taking a second look at those assets, and we've even seen some sellers increase pricing on those asset classes.
Interesting. Are you seeing any businesses expanding, Jason, to actually occupy the space in this environment? This economy?
I mean, there's plenty of that going on. People moving around their office space, either expanding or downsizing. Some people are going into bigger spaces to kind of spread their team out a little bit more. So yeah, we're seeing a lot of expansion, some contraction for some other companies.
Sure. Wondered, I don't know if any thoughts will come to mind, but who would you guess would be the big winners in the next, few years here in the Southwest Florida region in terms of like business categories? Obviously tech is kind of a given, but I know infrastructure, warehouses are going to be big as we're kind of moving towards that type of an economy. But I'm just curious, because you guys are in this market more often than I am, if anybody comes to mind, or any segments of any industries that you think are going to be big winners versus big losers, or if anything comes to mind.
Medical offices.
Yeah.
Healthcare.
Yeah.
A winner?
Definite winner.
Yeah.
Definite winner, I agree.
Anything near Lakewood Ranch is a winner. People really want to, we're talking to some investors who would like to develop medical offices, retail, and industrial parks on the fringes of Lakewood Ranch. That's still a wildly popular community that, as you know, is very highly rated and probably known all over the country.
I think they're going to be their own town soon, or their own city.
Yeah, absolutely. So yeah, I totally agree that Lakewood Ranch is like a destination now, and it's UTC and everything that's been developed there is just, it's amazing. So yeah, one thing that I'm curious about, just because I don't really know, is of course we've expanded into the downtown St. Pete, the Tampa markets. Are there different nuances between these different cities? Be it Sarasota, Lakewood Ranch, St. Pete, Tampa. What do you think? Are there different investment opportunities? I'd be curious your perspective on some of this.
I think St. Pete's certainly more of a densely populated town than Sarasota, and it's also connected to the larger capital market of Tampa. It's a little bit closer than we are. So I think there's a lot of investment opportunity up there for institutional buyers, regional investors, as well as local investors. I think Sarasota in the past has been a little bit more vacation and resorty, but obviously that's changing with every day that goes on. St. Pete has that as well, with Treasure Island and St. Pete Beach and those areas, but it just seems more urban up there, and there's a lot of investment activity, especially with national people. A lot of national developers coming in, developing huge multifamily projects, selling for record numbers. The Icon Central up there in St. Pete that was developed by the Related Group, that just sold for $150 million.
Wow, that's incredible.
So, I mean, there's a lot of action there, and I think Camden bought it. I think they're a Houston, Texas-based investment group.
Okay.
But yeah, I would say, there's just a lot of money flowing around up there just because it's so dense. There's a lot of jobs. It's more capital in nature than Sarasota is.
Yeah.
Absolutely. Yeah, the perception from the investors that we talk to, and as well as institutional level investors, is that St. Pete Beach is undervalued. It doesn't have as many national chains as other more developed beach communities such as Miami, Fort Lauderdale, for example. And what we're seeing is renewed interest in St. Pete, and Tampa. It has remained strong, I would say, throughout the entire pandemic, as a destination that people were relocating to, in part because of a strong job market. And there are all of the areas between Sarasota and Tampa St. Pete are coming up in value as well. Perhaps previously overlooked areas like Palmetto and Ellington, and then also between Orlando and Tampa St. Pete, Lakeland is a hugely emerging market. So the metros are expanding, and institutional investors are reaching into submarkets or possibly looking at opportunities that would be previously considered too small for them to be interested in acquiring.
Right, right. And speaking of institutional investors, I mean, we didn't prepare for any of these questions or anything, so hopefully it doesn't get too dense. But, in commercial, you guys are familiar with watching institutional players kind of move money around, and that is a big part of the commercial market. For my side of the market, what I'm a little bit more personally familiar with is more single family residential and small multifamily, things like that. And we're having a shift now that we've not really seen much of in the past, where institutional investors are getting heavily involved in single family homes.
True.
So, I'm curious maybe if you have any insights, just being a little more familiar with how institutional investors move money around, how they think about acquisitions and things that may shed a little bit of light on what's to come in the single family plays that they're making right now. So if anything comes to mind.
Well, I've definitely seen national companies acquiring several single-family homes and renting them out as if they are a single-site, multi-unit development, because they're seeing the potential increase in value over time, and they're looking at cash flow. We're also seeing a lot of builders acquiring land or even single or double lots and building spec homes. We see that in Indian Beach, Sapphire Shores. We see that near where you live, which for the purposes of this, I won't say, but it's a prime area of Sarasota. So we do see the monetization of single-family properties on quite a large scale.
I think that a lot, maybe the smaller institutional people too are getting pushed out of the bigger institutional deals as well, with values rising. So people are having to get creative. Someone that might have once been a multifamily investor, institution, and they buy these huge multifamily deals, maybe they're saying, well, maybe this isn't the right idea. Maybe we need to look at single family stuff with these values being out of control.
Right.
So
right.
I think people are getting creative, and there's more market players, more people are Googling how to be a real estate investor, and
it's definitely a fad towards real estate investing.
Yeah,
it's not an unfavorable thing, but it's become very kind of mainstream pop culture almost, if you will.
Yep, everyone wants to be a real estate investor now.
The passive income is the dream. Just work for a while and kick back, and then just kind of be able to enjoy that stream of income that you've created. Although I like the sentiment that you shared about, could you repeat that again, about not working for someday, or what was that you started the conversation with? I want to make sure I log that one. That was good.
Well, I would say that, speaking of the mainstream, if the average passive investor feels that it isn't any work to manage real estate, I can tell them that unfortunately it's not true. And if people think that they can have a completely flexible schedule by working in real estate, we always have a master. We always have a principal that has their own schedule, and that they might have a full-time job and they might be busy. If you like people and you're able to be flexible and you're in a fixed location most of the time, it's great. We have an investor customer who came down from New York and acquired several properties on Siesta Key, and is rents on a furnished basis. And he recently acquired a hotel property in a prime location of Siesta Key, and instead of time moving him closer to being retired and not doing any work, he actually became successful and acquired more and more properties, and is probably busier as he comes closer to retirement. On the other hand, we have customers who are free at 2 p.m. on a Wednesday because all of their properties are managed by third-party companies.
Right.
Although that might take up, in the case of a furnished rental, 25% of the gross revenue, and in the case of a commercial property, maybe as little as 10%, you still have to manage that third-party management company and ensure that you're getting the right value from them and that they are executing your short and long-term goals. So that would be my one word of warning about the fad, is that don't go into it blindly, and ensure that you have a plan. And just like with a stock, you might consider, what is my exit strategy for this property? Is that 3 years from now? Is that 5-10 years from now? Or is this a multi-generational property? My previous employer, Richard LeFrak, said, why would you develop a condominium? That is very similar to going through pregnancy and labor pains and immediately putting the baby up for adoption. So his thought is the best way to build wealth is to hold the asset for as long as possible.
Which I definitely agree with, and I've never heard that type of an analogy, and that's very true. It's almost like, to me, I've always thought it's probably less opportunistic to flip houses rather than to buy and hold, because you're taxed at a higher capital gains rate, and it's essentially a job. You're working for proceeds versus all the benefits of holding real estate over time. And never thought about a condo development the same way. It's very true. It's like flipping just hundreds of units at a time, essentially.
Another of our customers calls it brain damage. How much brain damage will I go through in developing this project?
How much stress? How many years off the life are you taking?
Which is also very true.
Yeah. Indeed. Absolutely.
What do and this is something that I would ponder, and I'm not presently involved in much development. I haven't done much of that, but it always seems to me, as somebody that wants to try to plan for the future as best you can and anticipate changes and things, how are developers assessing the risk right now of maybe starting a high-rise project that may not be coming out of the ground for the next 2 years or so and not ready for the market, until maybe 2024, 2025? Maybe, do you have anything that comes to mind to share how they're assessing these risks?
Well, a lot of them have a crystal ball that they look into. No, I'm just kidding. I would say that's a big challenge right now for a lot of developers, especially locally. That who knows what's going to happen? Who would have thought that we would be this busy a year after the pandemic?
Exactly.
There was certainly a lot of certainty in commercial real estate during the pandemic because of everyone working from home, there being less demand, everyone just kind of holding on to their cash, not knowing what was going to happen. And then when everything opened back up, especially down here, there was a big influx of cash, and it's been a crazy hot market. So, going forward, that's a big concern of most developers, is what's going to happen. Who knows? What's the Fed going to do with interest rates?
Right.
Just what is going to happen. I think locally for the luxury developers, there's always some room for improvement on the products that they're delivering, and there's always a different site that could be built on. And I think for the luxury market, there's always someone just trying to raise the bar up and up and up, and I think there's always going to be a demand for that. But for like the maybe B-class projects, I don't know.
Who knows?
I don't know the answer to the question.
Yeah, do you have any thoughts on that, Taylor?
We've seen at least one developer have to stall their project as a result of coronavirus and return deposits, and that may be a function of too many luxury options on the market at once. Like you're saying, if it's a B project, it could go really well because more people are able to afford that, and it might be more of a primary home ownership purchase rather than third or fourth home, as in the case of some of these projects that start at $2 million. It's also difficult to fund the project without any significant income from it for at a minimum of 2 years, which would be required for permitting and other issues. So a number of local developers have flipped their site and plans. So they would acquire a site and then go through the permitting and planning process, and then flip that to another developer who's better situated to fund the actual development and sales of that. And there's money to be made in that, but the risks are significant.
Right, and of course, the more well capitalized that you are and the more resources you have, the less risky everything is, because you can just kind of wait out the cycles if you've got enough cash on hand. It's kind of interesting to me. I was lucky to intern at a family office for a pretty affluent family in town, and was acquiring stocks on their behalf. But to me, to understand the math that you can correct all stock purchases over time with enough cash on hand, that you can just keep averaging down and just kind of putting more money into a company as it's falling. And then eventually when it comes back up, if you've averaged down enough, then you can make money in any situation. So there's
hedging your returns too. Yeah.
Definitely some advantages to having lots of resources at your disposal.
Indeed. I mean, one thing that I've heard you say in the past, which I think is very good for investors to keep in mind right now, is that if you don't make a purchase at the height of the market, then you still have funds available to capitalize on any dips in the market, and whether that's a one-off opportunity or whether that is a larger downward trend. Certainly there are investors that won't enter a market at the peak unless there is some value proposition that's compelling them to do that.
Absolutely. Yeah. Does anything else come to mind that we haven't spoke about so far that you'd like to share with our audiences here?
Nothing good.
Yeah, I mean, I'm just curious to take your temperature as we sit here in September 2021. How optimistic or pessimistic that you are for the future. What's just your general gut feeling for, where we're at right now, and as an investor, just curious.
The future for Sarasota is extremely favorable. And the skyline will show that. Despite everything that we've said about challenges, there are very exciting and large-scale developments that have been recently completed that are coming to town. Moat Marine is relocating to UTC within the next University Town Center, which is a large-scale shopping, dining, and residential development by Benderson. So we're seeing a shift of the vacation destination and retirement destination to a real place that people want to live in, that is less based on seasonality, less affected by temporary issues such as red tide, and that should bring a stable job market, and hopefully will help to curb the issues we were speaking about earlier, which is that people might have to pay 50% of their income in housing costs. And so the further east they go, perhaps the less they may have to contribute as a percentage out of their income. And we're seeing formerly sleepy towns where you could probably take a nap in the middle of your street, like Venice, is now becoming a place that investors want to invest in. Jason is about to sell a property just north of Venice that when you got the listing, people weren't really interested, and then suddenly everybody wanted this property, which might have been expensive for what it was.
Yeah, it was a low cap rate, multifamily type deal, and what you would think would be too low for it. We got a lot of out-of-state buyers interested in it. So
yeah, very good.
We do. Oh, sorry.
No, you go ahead. I was just going to say my general opinion on the market conditions and the way things are heading. I'm certainly optimistic with everything. I think at some point it's going to have to plateau a little bit.
Yeah.
I don't necessarily see a big dip coming at all. I see just more and more people moving here, more cash, more demand for Florida in general. And so maybe a plateau is on the horizon at some point, but I'm very optimistic and bullish on Sarasota, St. Pete, Tampa, the whole west coast of Florida.
Yeah, love it. I agree with both of those sentiments that, we should fare pretty favorably here in this part of Florida at least, and beyond. And, maybe some of the northern states don't fare quite as well, and we see cracks in some of those markets first. and it may not ever really trickle to this part of Florida too terribly much. I mean, no market's completely impervious to risks, but looks pretty good for us here for the foreseeable future. So yeah, I can't think of a better way to end on an optimistic note like that. And if people would like to reach out to you to learn more or ask questions or whatever, Taylor, what's the best way to reach you?
You can call me or text me, 917-880-0769, or reach anyone on our team by phone or email.
Yeah, and Jason, what's the best way to reach you?
Yeah, call, text, email, 941-685-1228. It's my cell. And if you guys have any questions, want to pick our brains a little bit, feel free to reach out.
Yeah, we'll want to thank you, of course, both. Thank you, Jason, for the good work you do with our realtors, giving advice and guidance as one of our brokers here to the realtors, both on the commercial and residential side. And of course, thank you for joining us on the podcast, Taylor. We're really excited to welcome you to the company and do some good work together. So thank you guys.
Thanks for having me. It's a pleasure.
Absolutely.
Yeah, thanks for having us.
Yeah. Well, thank you all for joining us today, and I'm sure we'll be speaking again soon. Bye, everyone.